Welcome back. The day belongs to the IT pack. Even in the broader markets, names like Mphasis are higher by close to about 4%. Let's find out if the outlook as echoed by HCL Technology is something that other IT companies also share. Is FY21 going to turn out to be a good year for these companies? Nitin Rakesh, the CEO and Executive Director of Mphasis, now joins in. Nitin, thanks so much for joining in. Increasingly, a lot of IT companies are sounding positive. What is driving that? Is it the fact that tech spends are moving up, or deals which were previously put on hold are now ramping up? Is it on account of better execution? Your thoughts?
The biggest thing that is driving a lot of the tech demand right now is the fact that, the last 6 months, especially with the lockdowns and the COVID crisis, it's been a major accelerant to a number of trends that are already underway, especially, everything digital, is right now very, very much in demand. So I mean, think of the fact that it took 10 years for US e-commerce to get to 15-16% of total retail, and then 3 months to go from 16 to 30. Right. So we're talking about progress that was made over multiple years, getting accelerated into a very short time frame. And an omni-channel strategy for a retailer or a bank is suddenly shifted away from being omni-channel to being digital first, or in many cases digital only. So I think that's driving a lot of the very short-term demand. That and a lot of clients are looking for help in this whole resetting of their reprioritization of their digital strategy. I think longer term, it's also getting clearer that a number of these trends are here to stay, and I think that has also led to what our clients are calling a relentless reprioritization of their tech spends. So spends haven't come down; they're probably holding up. In some cases, gone up, but they've been reallocated and reprioritized towards these services, and that's driving some of the very short-term deal dynamics and demand opportunities.
Well, Nitin, we want to understand simply, is FY21 turning out to be better than what you were expecting?
The question is, who you ask. I think this is a year of contrasts. On one hand, companies that have the right, set of capabilities in the right sectors will actually see this to be a decent year. We called for growth bottoming out in Q1, despite everything else that was going on. And I think from that perspective, we do see sequential recovery starting Q2. But then also, this is also the year where the divergence between the best performing, businesses in our industry and the not so well performing businesses will be very high, probably as high as double digits on a percentage growth basis. So I think this is a year of contrast for sure. So, on one hand, yes, but I think also if you don't have the right exposure to the right services and the right sectors, it'll be a difficult year.
You did say that you're expecting growth in Q2. Can you throw some more color on that? And are you also holding on to your margin guidance of 15.5% to 16.5% at the EBIT level?
I think, we're still, basically aligned to the guidance we gave last time, which is that we do expect growth to return from, Q2, and we also expect full year to be a growth year. I think there's still, a lot of work to do, especially around, the dislocation in supply chain. So for us to get a little bit more confidence, we need to see that ease up a little bit. So we are still operating pretty much in a virtual remote mode. And while we've taken on that job, I think some of our clients are still kind of working through some, how do we onboard, how do we ramp up deals. So I think demand is there, conversion's getting better, but I think we're definitely at a point where we do see this to be a growth year, and like we had guided before. On the margin front, I think we are we're looking to hold the margins in the band that we guided earlier, primarily because we think there's an opportunity for us to take any leverage that we are getting and invest that back into staying growth oriented. So from that perspective, I think we still maintain the margin guidance as well.
Oh, that's encouraging. Then, Nitin, what about your deal wins? They were at record levels in the first quarter. The deal pipeline as well was strong. If you can tell us what has changed in the last 2 months.
I think the pipeline is still fairly stable. We are converting at a healthy clip. We are adding new deals to the pipeline. We're starting to see, clients get a little bit bolder in thinking about, some longer term transformation programs being accelerated as well. So I think that's the biggest change from the last time, that, what seemed to be immediate prioritization is now starting to spill over into acceleration of the longer term deals. The only difference being that unless they're able to see impact of the longer term programs in 3 to 6 months, those conversations have pivoted towards a model where they're able to see the longer term impact play out sooner as well. So I think in a number of ways, acceleration of the trends has also led to acceleration of expectations, and that's the biggest difference in the way we're seeing clients engage with us.
Nitin, just talking about the internals of Emphasis, digital risk in particular. Now that's had a good quarter. In fact, the last few quarters have been good. In Q1, the revenue run rate was $35.5 million, so much higher than your guided band of $28 to $30 million. Would you look to revise your guidance higher? Is this growth rate sustainable?
Yeah, I think that was a band that we had wanted to come back to, but the last couple of quarters we've obviously been higher than the band, and we expect to stay at elevated levels, primarily because of the acceleration we are seeing in the business, the wallet share gains we are seeing with our clients, and the cross-sell opportunity that that business is actually creating for us outside as well. So I think it's been a good, I would say, tailwinded environment, but at the same time we've also restructured the way we integrated that business in our core business, and that's paying a lot of dividends as well for us.
Well, BFSI is the largest vertical for you at roughly around 58-59% of your revenues. How are the client spends and what is the growth looking like?
I think on the banking side, if you look at it, clearly they've been following this relentless reprioritization, given that a number of their immediate priorities are focused towards customer experience, as well as looking at how best can they replicate the omni-channel experience on a digital mode only. So I think there's been significant, I would say, uptick in customer experience type conversations, cybersecurity, and while they were always adopters of cloud and things that create that virtual experience, now they're starting to actually think about really moving large applications onto the cloud versus just doing incremental work on the cloud. So I think there's a good tailwinded environment on the overall banking side when it comes to how they think about the tech spend in the future. In fact, some banks, and this based on third-party data we've seen, their spends have been higher in the June quarter than they were in the quarter before. Question is, will that sustain? But we do expect that to be a good segment to be in, especially if you have the right set of services. There also is continued focus on right partnerships. So there is an element of reprioritization of the right partners. Some of it is size driven, the very small niche tail vendors. Some of it is much more capability driven. So I think that's another trend that we continue to see there. On the insurance side, I think there's much more work to be done by the insurance segment because they were a little bit less ready for the digital only world. So there's a significant amount of work being done on digitizing the insurance value chain and the workflow. And that's leading to some interesting opportunities on end-to-end digitization of the process as well. So I think both are good markets to be right now, and both throw significant opportunities. Definitely the medium to long term. Short term, obviously, there has been the relentless deprioritization by many clients, and some of that is playing out as we speak.
DXC revenues have contracted sharply. What is the outlook that you have on recovery?
We guided that as we kind of get towards the end of our 5-year MRC period, we continue to just stay focused on making sure that we are able to consume the minimum revenue. And that's kind of trending towards about a $50 million quarterly number. That's not a surprise to us. We planned for it because, as we talked about over the last few quarters, we've reprioritized our growth on the direct channel as well, and that's the way we expect that to continue to operate.
Okay, final question, Nitin, before we let you go. Then the Blackstone portfolio, that's growing very well for you. It's currently roughly around 5% of your total revenues. What is the opportunity in this part? That's the Blackstone portfolio.
I think we've basically that's embedded in our direct core business, and I think from that perspective, we'll continue to work with that business in a way that we make that a growth channel as it has been. The growth rates are fairly high, 30 to 50% are growth rates, but now it's embedded in our direct core business, and it's definitely a driver of growth. And I think I've called for that opportunity to be fairly large. We do have visibility into, can we go from, mid-single digit type of revenue exposure to doubling it in the next, couple of years. And then, because the opportunity size is fairly large and our wallet share gains have been strong, but, we're still a small percentage of the overall spend.
Well, that's the word coming in from Emphasis, reiterating that Q2 will see growth FY21 will be a growth year for the company. They're also sticking to their margin band of 15.5 to 16.5%. But some of the more interesting long-term takeaways is that now clients are not only looking at doing incremental, smaller work digital. He did say the clients are getting bolder in thinking about accelerating long-term transformation. So that would imply big projects, not just for the company, but I guess for the industry as well. And even banking clients are now have started thinking about moving large applications on cloud. So it looks like this whole digital opportunity that everyone's been talking about could actually be quite large for the IT companies. Here's what we'll do. We'll slip into a very short break.